Welcome back to Markets Today. I'm Ibrahim Sani. Now, next week, we will have a full-length interview with the CEO of Edotco, Senam Berhad, a member of the Axiata Group. Edotco offers telco services, tower services, to many of the telcos in Malaysia as well as other countries. Here is a snippet of the conversation that I had with the Edotco CEO, Suresh Sidhu. Take a look.
I think when you look at numbers, you have to look at the whole. And on a quarter-to-quarter basis, there are always movements, which as long as you understand what's happening, you can either take corrective actions for, or you can understand just consequences. So firstly, I think what's good about the numbers, a high revenue growth and a solid EBITDA. On the net profit side, the main reason is FX movements. So I think that will account for most of the movements in net profit for Edotco year-on-year or quarter-on-quarter. The challenge of being a multi-country operator is that you have to operate in many different currencies, and you have exposures that are often connected to the USD, to the ringgit, and to the local currency.
And that's why we focus very much so on the ratios, particularly the growth ratios. And both Axiata and Edotco does have strong ratio growth. Many of the analysts out there, particularly after the announcement of the results, gave a very strong recommendation towards Axiata, saying that the growth numbers are quite favorable, particularly heading towards the fourth quarter. But zooming in on Edotco, the acquisition on Pakistan, it's going to be huge for your company. Do you think that this whole exercise can be completed within this year?
It's a tremendous opportunity for us, and we're very excited. You're right, it's huge. It adds over 13,000 towers to our portfolio. So we go to a nearly 40,000 strong sort of tower portfolio company. We're really driving to get the acquisition completed this year. We're going through approvals. We have the first set of approvals from the Competition Commission in hand, and just working through the rest of the process in Pakistan. There's always a slight risk of delay. We don't see that if anything happens, that it would be more than a month or two. But the current target, let's try to get the transaction closed by year-end, and so next year have a 40,000 portfolio fully operating under the Edotco banner.
Last year, Axiata suffered a little bit of a loss, particularly for the FX losses, and it was reported earlier this year. And of course, going towards the end of the year, we're seeing the FX risk hitting the bottom line as well. Do you think that there will have to be a serious way of managing the FX risk, particularly for multinational businesses like yourself in Edotco?
You know, I think it's an issue that we've always talked about, both as management team, also with the investor community. The reality is that when you do multi-country operations, you have to put up with some level of FX risk. And actually, movements of the FX one way or the other depends on whether you're holding cash or you're holding debt, and in which currency. So it's not an easy thing to predict. What we prefer, rather than to proceed to look at options like hedging, which is very expensive, particularly against operating cash flows, I think it's very hard to find the right instrument to help you, is to instead employ methods which we call natural hedging. So, for example, with the deal in Pakistan, we're sourcing a lot of the debt onshore in Pakistan rupee. So the debt you have matches the revenue profile you have.
So it's basically insulating you from the FX risk?
Yeah, not 100%,
yeah, of course.
But a much larger proportion is therefore matched to the local currency.
Is this, therefore, the cognizant management approach for other markets that you guys operate in?
Absolutely. You know, we are putting in a capital structure which we feel will be more efficient. It's not something you can do overnight. I think step one was to capitalize the business, to carve out the assets from Axiata. We did that mainly with equity infusions from Axiata. Step two was to increase equity in order to buy assets like Pakistan. And that's when we had the fundraising with Khazanah, INCJ, and Co-op becoming investors.
Of course, Co-op coming in very strong at over $100 million.
That's right, this year. So, you know, and I think they proved to be very strong, supportive shareholders. Both themselves, the Japanese and Khazanah, I think, have very independent voices and, you know, have been providing great guidance to us as a company. And encouraging us to do step three of the capital structure, raising more debt. I think as a towerco, we have to bring our debt levels further up in order to sort of really maximize the value of what we're building. So post-Pakistan, we are probably expecting that we should get our debt levels up to about 2.5 times EBITDA, which is reasonable. And we'll probably be working with the Axiata group in the coming year to see how we can further access opportunities to raise more debt as well.
With the debt raising exercise, are you going to be issuing papers as well and raising debt from the capital markets?
At this point, no. I think we're looking at commercial loans, particularly because of the natural hedging strategy I just talked about. You want to have sort of currency, matching in various countries. We feel that for what we need right now, which is mainly to fuel the growth post-acquisition, we can manage that with onshore commercial debt. Of course, if there's a further acquisition opportunity, we'll explore other options.
So you can watch the full interview with me and Suresh Sidhu of Edotco, member of Axiata, next week on astrawani.com. Finally, our last story is on the Sime Darby listing, which is going to happen tomorrow. Tomorrow is a big day for Sime Darby, as the company is going to demerge and form into 3 major listed companies. And ahead of the listing of Sime Darby Plantation Berhad, or SD Plantation, and Sime Darby Property Berhad tomorrow, Fitch Ratings has assigned ratings for the 2 Sime Darby companies. If you can find it on our astrawani.com story, namely these 2 companies has been assigned a long-term foreign currency issuer default rating, or IDR, of BBB+ with a stable outlook, and a senior unsecured rating of BBB+, with also quite a stable outlook as well. And Fitch has also removed the rating watch negative on the $1.5 billion Sukuk program and the outstanding issuance under the program, which was transferred to SD Plantation from SD Berhad, or Sime Darby Berhad, in May this year, and affirmed them at BBB+ yet again. And many of these stories come into being whether or not the profitability of the company is going to be impacted following the demerger exercise. A lot of analysts are now saying that this is a futile effort in trying to improve the company's intention to do a pure play business. But of course, as we have heard earlier this year by Tan Sri Wahid, the chairman of PNB, there is a deep intention to make these companies pure play. So going tomorrow, you will see Sime Darby in property, Sime Darby in plantation, and of course the parent company doing other stuff like motors. That wraps up this episode of Markets Today. Be sure to follow us on Facebook, Twitter and Instagram at 501 Awani. Download our app on the Google Play and the Apple App Store. I'm Ibrahim Sani. Thanks for watching. Goodbye.